Okay, so we'll go ahead and get started. And if anyone has any questions, feel free to speak up or type them in the chat. So today's conversation is going to be all about option strategies. We're going to focus on two strategies in particular to help you get to financial freedom, earn extra money in your account, and reach your goal, your investment goals. And I hope that each and every one of you has a goal that you have for yourself while you're investing. It only makes sense to have a target or to aim at a certain goal. It might be to reach, let's say, $10,000 in income by the end of the year. Or your goal might be to become a better investor and learn as much as possible over the next several months. Whatever your goal might be, as long as you have one, you're definitely in the right direction. So when it comes to getting towards that goal, especially generating income in your account, there are two strategies that I absolutely love that we're going to cover. We're going to talk about covered calls, and we're also going to talk about cash secured puts and how these two investments can generate extra income in your account. There is some background information about these two option strategies that you should know to become a little bit more familiar with what options are, how they trade, what expectations can you set for yourself as you're trading them, and how can you really gain the most out of the trading that you're doing, especially with these two option strategies. So first, I want to talk about what options are. Options are essentially a contract. So we have the ability to either buy or sell an option contract on the stock market or the options exchange. There are about 14 different option exchanges that are out there in the United States, and your broker, through trading, kind of determines through that process where your option contract gets routed to. The most popular is the Chicago Board of Exchange, or the CBOE, Chicago Board Options Exchange. There are several others. You don't have to memorize who they are or be so stuck on where your contract is being routed to, but you do need to know that the actual contract, the option contract that you're going to be buying or selling, is a derivative. So it is an instrument that is out there, and it is an instrument that you have the ability to trade and barter or exchange. So if you are going to be buying a contract, in most cases, on the other end, there's also someone who is selling that contract that you're going to be buying. If you're going to be selling a contract, on the other end, there is a buyer who's also buying that same contract. So there has to be a market for the instrument or contract that you're exchanging or bartering. So that is a requirement. If there's no market for the contracts, then you won't see any volume or activity for contracts for that stock. So the other thing you want to keep in mind is that the price of your option contract is tied to the price of the stock that you are going to be buying or selling. So, for example, if the price of the stock goes up, the price of the contract might go up or down, depending on the way that contract trades and what we expect, whether we're optimistic and we want to see the market go up. There are certain contracts that will go up when we see the stock price go up. And we'll also see the value of those contracts also go down when the stock price goes down, depending on the type of contract that we're trading. So the price or the value of that contract is tied to the stock price. And that's very important to keep in mind. My goal is to give you some examples so you can see what that looks like and what opportunities you can take to maximize your value, maximize the amount of money you're going to get when you're actually trading the contracts. So, to dive in a little bit deeper as to what an option is, on the next slide, we're going to talk about the structure of these contracts. And when you talk about an option and what it is, it does have a structure. It's made up of these components. You are going to be either trading and opening, starting a transaction. That's called opening a transaction. You might be selling to open or buying to open. And you can also close your contract and end your contract. So you might be selling to close or buying to close. So you also have the type of contract. That's another feature in the structure. We have call contracts and put contracts. Those are the two different types of contracts, calls and puts. And don't get so boggled down on the terminology, but as you get familiar with what they are, this idea of a call or a put will become more understandable. You also have the quantity of your contract. When you talk about an option contract, each contract, so one contract that you purchase or sell, represents 100 shares of a company. So that is the ratio. One contract represents 100 shares. Very important to know. So you're not just buying one share when you have a contract or own it. Your one contract represents 100 shares of a company. You also have something called the strike price. I like to think of a strike price as a trigger. The strike price will determine the price of execution. Whether you have a call contract or a put contract, that strike price is very important and really drives when you're going to see action taken against the contract that you own, that you're selling, or that you bought. And that strike price will help determine the value of the contract as well. And you'll see that in some of the examples that we'll see. And the last component that is in the structure of an option contract is the expiration date. So just like most contracts, some contracts, maybe legal contracts, don't expire. You know, you write a contract to do business with a company, and this is set on certain terms and on a certain date. For options, you actually see that contract expire. So these contracts are not permanent. There are expiration dates and they actually dissolve or expire in value. So they're not permanent at all. And I think that's really great because it gives you a lot of flexibility. There are weekly expirations for contracts, and there are also monthly expirations for contracts, and there are also yearly expirations on contracts. Basically, depending on the stock that you're trading, you could have a variety of different dates. The contracts typically expire on a Friday, and the expiration date is determined by the options exchange. So you do not get to determine when the contract expires. It is the options chain or the option exchange that creates these contracts and determines when the expiration dates are. There are some companies that don't have weekly expirations. In the examples we'll see, there are companies that only have monthly expirations. So you might be limited as to when the contract expires. But the important thing to know is that there is flexibility and you can have a variety of different expirations. That's really great because you might want to actually invest or have these contracts only for a certain period of time, maybe for a few months or a few weeks. And once you finish investing, you're going to use the money to do something totally different and invest in something else or do different strategies to invest the money. So the fact that there are different expirations adds that flexibility for you and gives you a chance to sell or buy different contracts throughout different periods of time. So that is a really good thing. So I want to ask, in case you guys have any questions, feel free to speak up, come off of mute, or type in the chat if you've got a question so I can help answer that about the options structure and what I've shared so far. And I'll just pause to see if anybody has any questions. And I'm going to check the chat just to see here. All right, so no questions in the chat so far. Okay. All right. Oh, we've got a question. So Mr. Smith asked, what happens if you forget to sell a contract? Uh, it can happen. So on the expiration date, if your contract is what we call in the money or reaches the strike price, the execution price, then action will be taken to resolve that contract. If for some reason, which is a good thing in some cases, if your contract has not reached the strike price, then your contract will expire worthless. And if you're earning income on your contract, you will get to keep all of the income that was given to you when you initially started the contract, and you will not be responsible for the fulfillment of that contract. So it will expire worthless. There are contract types that require you to put money up front, like buying calls. You will lose that money and your contract will expire. So we're gonna get a chance to see those too. So you definitely want to kind of follow up. I think playing in the options market is a semi-passive way to be a part of the stock market. It doesn't require you to look at your stock price or your contracts every day, but you do want to check at least once a week or every other day to see how your contract is doing, what the stock price is of the underlying stock, so that you can be aware of what will happen come expiration. So you don't want to forget about it entirely. But if you do, it's not always the end of the world. So you do have the ability to also close or reverse your contract. You can close your contract before the expiration date so that you don't fulfill the requirements of your contract. So you do have that flexibility as well. Okay, that was a great question. So we've got another question that just came in. Okay. Oh, so somebody just asked, how often should you participate or write contracts? So it all depends on you. The strategies that we're going to see, the two that we're going to cover specifically, you can be a part of the stock market depending on the amount of capital you have, if you have the cash to cover these transactions. So you can do this once a week, once a month, just depends on your preference and how often you want to participate in the stock market. Absolutely no requirement in participating. You can just let your money sit in your brokerage account, but to get the most out of options trading, you should participate so you can actually see the benefits and receive the income from these option strategies. So it is entirely up to you as to how often you want to participate. So let's talk a little bit more about some of the basics that we've covered. Keep in mind, one contract represents 100 shares of stock. So on this slide, we're going to see that there are about five, maybe four to five different strategies, option strategies. Definitely want to be aware of what these strategies are. And these aren't all of them. There are more than the five that are listed here. So we have buying a call option, selling a call option, buying a put option, selling a put option, or creating spreads. Not all strategies are basic. So some of these strategies require some advanced knowledge and advanced participation in the stock market. So if you're just starting out, some of these strategies might not be easy to comprehend. But my goal is to share at least two strategies that you can walk away from today that will help you understand the basics and be able to participate with at least two of these strategies. As we'll see on the next slide, we're going to talk about strategy number 2, selling a call option, and strategy number 4, selling a put option. Some of the considerations that you'll want to keep in mind as you're participating in option trading, no matter what type of strategy you are participating in, you will want to be familiar with the quality of the company. You don't just want to trade options on any company. You want to choose companies that are going places. Sometimes you might want to choose companies that are failing, depending on what strategy you're taking a part of. And maybe the stock is going down, you could actually capitalize on that downward movement and work on generating income, even though the stock price is falling on a stock. And the total opposite. Maybe the quality of the company is really good. As I mentioned, the company might be going up in value. You want to capitalize on that upward movement and generate income as the stock is moving up. And that's why I like options. You have that flexibility no matter what type of market conditions there are. If the market conditions are good or they're bad, you can generate income in both types of market conditions. You also want to be familiar with consistency of your stock price. So you want to be able to know or at least predict where your stock price will be tomorrow or in the next week, in the next 3 months. Might be a little too much to predict, but at least the next month, if you have an idea of the historical pricing and where your stock has been, if it has gone up in value over the last 3 months, or there's a downward trend, it's continuing to go down in value over the last 2 months or the last week. You do want to be familiar with the average price and look over time and see over time where and in what direction the stock has been moving. and be able to predict. I know prediction is not guaranteed, but at least have an idea of what the future stock price might be that you're going to be expecting to see for the underlying stock. I like to use Google Finance and Google to chart and see what the stock price looks like. In a moment, I'll pull up Google so we can take a look. But it's really user friendly. They have really nice charting. You can also use historical pricings to see a chart of what the historical prices look like. So I'm going to pull that up so we can take a look. And you also want to be familiar with any news that might be affecting the stock price. This could be positive news or negative news that is affecting the price of the underlying stock that you're going to be trading. Positive news can cause your stock price to go up, which might be a great thing. And you can continue to earn income and capitalize off of the price going up, off of the good news that's out there. Also, you might have bad news that causes the stock price to go down. So you do want to be familiar with what's going on with the company and follow your stock. Be able to check in and see what kind of news headlines are out there as you're holding on to your contract, because that will affect the stock price of the company in some cases. You also can be familiar with fundamentals. So that includes being able to know the earnings, the reports, the financial reports of your company for the stock price that you're trading, and be able to have a familiarity with how well financially that company is doing. You certainly don't have to be an expert in fundamentals or stock fundamentals, but it is good to be aware of earnings, how much your company, the underlying stock, is expected to earn, earnings per share in the future for the next quarter. And they do a great job, Google, at providing that information when it becomes available. And you can also research that information to see in what direction the company is headed towards. So I want to share some examples of what these strategies look like, especially the two that we're going to cover, and also pull up Google charting so we can see some of the trends that we're going to see. So you can see one of the resources that you can use to look or evaluate the stock price. So on the next slide, we have these 4 boxes. So I mentioned earlier that there are about 4 or 5 different trading strategies. I set these 4 strategies up in 4 different boxes so that you can see kind of when the action happens. So at the top, you're going to see strategy number 1 and strategy number 2. Buying and selling a call option. If you are optimistic about the direction of the stock that you're going to be writing a contract for, then you generally want to have bought a contract, you want to buy a contract, or you want to be in a position to sell a contract. So that's when you want to take part in those strategies. If you are pessimistic, so you're seeing the market possibly going down, or we're in a bear market, you want to buy puts or sell put options as your contract strategy. So that's when you want to work on those strategies. Buying or selling puts in a downward market, you'll get the most income that way in those types of markets. And the 2 that we want to focus on today are selling call options and selling put options. So I want to focus on these 2 strategies specifically because these are the strategies that actually help you earn income right away. As soon as you write or participate in this contract, you're going to earn money. You don't have to wait for the money to be deposited like, weeks later or things like that. You gain money right away in your account, and you're going to see that money deposited as soon as that contract is written. And focusing on this side of the chart or this side of the table lets you earn. And I like that a lot because you get to see the value right away in the contract that you're writing. So we're going to take a look in deep detail in selling call options and selling put options. So to describe the strategy for selling a call option, I have these bullets here on the slide that you can see. And when we're talking about selling a call option, it does require you to actually own. You have to own shares in the company. So that means you must own, for example, 100 shares of Tesla, or you must own 100 shares of Macy's. Whatever the stock is, you must own it. So that is a requirement of selling a call option. You must have the stock or the shares already in the account. Now, keep in mind that one contract represents 100 shares, so you must own 100 shares of these stocks or of these companies. And when you own 100 shares, you can write one contract against those 100 shares and sell a call option. So I'm going to show you an example of what that looks like and where I've earned income on a call option. And as you're owning these shares, let's say you bought 100 shares of Macy's in your account, and the shares are just sitting there. Maybe you bought the shares at $18 per share a long time ago. You bought 100 shares of Macy's at $18 months ago, and the shares are just sitting in the account. Instead of them just sitting there, you can write contracts so that you can earn money either weekly or monthly on those shares that are already sitting in your account. And the goal is that as you own these shares and you have these contracts, the price of the stock will increase over time, and you're going to see your contract give you income as the value of the stock goes up. You can write or create a contract to sell these shares in the future. So that is a component of selling a call option. You must own the shares, and by writing this contract, you're actually agreeing to sell these shares in the future at a certain price. So that is a requirement. Once you sell a call option and you agree to sell these shares at a certain price, you will earn income or a premium for selling these shares at a certain price in the future. Let me show you an example of what that looks like. So let's say we bought 100 shares of Macy's like 5 months ago when the stock price was really low. And when we bought these 100 shares, we later decided to write one contract of Macy's, and we want our strike price to be $25. So we're saying that at $25, that is our strike price. We will sell these shares of Macy's in the future when and if they reach $25. And they're trading at $25 in the stock market. And we want our contract to expire on March 17th, 2023. So these shares have been sitting in the account, And this contract will give me some income while I'm waiting to get to the expiration date. So right now, because I'm going to sell this contract for Macy's, I have a strike price of $25. So if we reach $25, the shares will be sold. That will be execution, and the shares will be in the money and be taken out of my account. I'm going to earn the money or the difference between $18 and $25 because I bought the shares at $18. I will see the profit of selling the shares at $25 if this contract gets executed. If this contract does not get executed, let's say on March 17th, Macy's is not trading at $25, I will get to keep all of the money, all of the premium that the contract paid me, and I don't have to sell these shares if the shares are not trading at $25 on March 17th, 2023. So those conditions cannot be met, so I can keep my shares and keep the premium that I earned, even though I wrote this contract. I don't know if that um, really makes sense until you actually see an example of what that looks like. Let me know if you have a question so far. Please feel free to type in the chat if you do. And on this next slide, I'm going to share an example of some of the premiums I have earned on some of the contracts that I have written. These are call contracts that we're talking about, remember? So here, this is on a company called Chico's, or the ticker symbol is CHS. And you'll notice here on the far right in green, I earned $68. I also earned $58. I earned $118. And these were on 3 contracts. So these were 300 shares of Chico's that I owned in my account, and I wrote 3 contracts on these 3 different transactions and earned this much in premiums when I wrote the contracts. So I got to keep the money. This $68, I got to keep it because on the expiration, and you can see here, it shows EXP on February 18th, 2022, Chico's was trading for a price below $5. So this was a $5 call contract. Chico's was trading at a price below $5. Just going to show you what that looks like. So here I pulled up the chart on Google, and you can see the marker here on the chart showing that on February 18th, Chico's was trading at a price of $4.67. So I wrote this contract weeks before February 18th. And when I wrote the contract, I hypothetically expected the price to stay below $5. And the goal when you're writing call contracts, when you're buying these shares, is that you buy these shares below the strike price. Our strike price here is $5. So I bought them, let's say, at $4.95, and they were less than $5 per share. I bought 300 of them, so that required some capital. Just to pull up, I don't know if anyone has a calculator, 300 times 5, maybe that's 1,500. My math might be off, but I needed $1,500 to buy, $495 times 300. So let me pull up a calculator really quickly just to show you what it cost me to buy these shares. So I bought them at $4.95 and I bought 300 of them. So it required me to spend $1,485, almost $1,500. That was the required capital I needed to buy 300 shares at $4.95. So I bought them low and I set up my trading ticket so that my strike price, the price that I'm agreeing to sell these shares for in the future, would be $5. So that's a, a gain. I would gain money if I was to sell these 300 shares at $500 per share. Excuse me, at $5 per share. uh, so let's say I wrote this contract and I actually saw the strike price reach, and Chico's was trading at $5 per share. So 5 times 300 is $1,500. So I would have earned minus 14.85. I would have earned $15 for the contract spread, just actually having the contract expire. Let's say Chico's actually reached $5 per share on our expiration date on February 18th. I would have earned $15 plus I would have earned any kind of premium, which was the $68 premium. I would have earned that premium as well, giving me a total earning of $83 for writing this contract and seeing it expire. But because Chico's did not reach $5 on February 18th, it was $4.67. I got to keep all of the premium, the $68 premium for the 3 contracts I had written. I did the same thing and rolled that contract. I wrote the contract again for an expiration of March. So the next week, so it expired on February 18th. So like 2 days, 18, 19, 20th, let's say the 20th was a Monday. That Monday on February 20th, I went into my account, I wrote another contract, and I wanted it to expire March 18th. I just rolled that over, and on the March 18th expiration, that price of $5 still wasn't reached. So I earned more money because Chico's was not yet trading at $5 per share. I don't have the date on this chart right now, but let's say it was at 4.87. It was trading at $4.87 on March 18th. It's trading below $5. I'm going to keep my premium and I'm still going to keep those 300 shares in the account that I bought at $4.95. Then I continued the same process. Since it didn't reach $5 on May 18th, I wrote another contract on May to expire on May 20th. And let's say finally on May 20th, it reached $5. They took those shares away and sold them out of my account at $5. Remember, I bought them for $4.95, but the strike price was $5. So they got sold at $5 on the expiration on May 20th. I got to keep my money, earn my premium, and that premium was $118. I got to keep that, and I got to sell the shares finally on May 18th. Excuse me, May 20th. That was the expiration on May 20th. So that is an example of selling a call option. You're literally earning free money on the stocks that you're already holding in your account. You're just writing contracts to earn premiums for these shares. And you're earning these premiums as you're holding the stock over time. But as I mentioned, if your strike price is reached, here our strike price was $5 for each of these three, then at that strike price, you will see your contract fulfilled, and they will take those shares away and you'll earn your money, and you'll have to start all over again, going out to buy more shares and then writing more contracts again. So the idea is to really look at the stock that you're going to be writing contracts for and consider whether it will grow, it will see an increase in its price, in the stock price over time. And they'll kind of estimate, you really want to be able to estimate if your contract will be fulfilled in the future because it reached your stock price. And I see we've got a question in the chat. All right. So somebody asked, when do you lose money on this contract? So in my opinion, when you're selling a call, selling a covered call, you don't really lose money if you're selling a covered call on a good quality stock. If the stock, let's say, is Ford, or Macy's, or even Tesla, and you're seeing the value of the stock go up over time, you've seen the patterns of that stock, then eventually, even if your contract expires because you've never reached your price, your strike price, you'll be able to sell those shares sometime in the future. Maybe you won't sell the shares through this process of writing contracts, but eventually you'll see the stock reach that price, whatever price you're desiring. You're going to see that stock reach that price. You can still sell your shares in the future because that stock is a quality company and you eventually reached your price. So if you're writing contracts on a good quality company, you're really never losing out on writing covered calls. If you're writing covered calls on a quality company. So that's my perspective. But if the stock price tanks, let's say the company goes flat, out of business, the stock price decreases in value tremendously. Maybe you bought the shares at $30 per share. Now they're trading at $15 per share. You're not really earning money on it anymore. Then you will lose out in that perspective, just because the value of the stock has gone down considerably. You've lost double the stock price from where you started. You bought at $30, but now it's trading at 15. Maybe the quality of the company isn't that great anymore, and the expectations of the company are horrific, and you're not doing well right now. So I want you to keep in mind that today's winners can be tomorrow's losers. Also, today's losers can be tomorrow's winners. So you might see, even though the company that you purchased might be doing well right now, they could actually be doing really bad in the future and perform poorly in the future, or the total opposite. We can't always predict what the stock price is in the future, but as you keep up on company news, earnings, and look at the fundamentals of a company, it will help gauge how well the company will be doing in the future. That's one of the reasons why you might want to sell contracts weekly so that you can predict where the price will be in the next week versus the next 6 months. You might not be comfortable with waiting for a contract that expires 6 months from now, because the performance of the company could be tremendously different 6 months from now compared to a week from now. So having that longevity and that flexibility having weekly contracts versus monthly contracts can let you set your expectations at different dates so that you don't lose money and you can have shorter or weekly expirations instead of monthly or yearly expirations. You can lose money, for example, if you have a contract out that's really far out in time, like let's say 6 to 12 months from now is when your contract will expire, then that's really risky. You don't really know, you can't really predict where the stock price will be 6 to 12 months from now. So that's more riskier the longer time period that you have for that contract to expire, just because we don't know what's going to happen in the future and you can't predict where the stock price will be. So to me, that is a lot riskier and you can lose money on a covered call that way just because you can't predict the stock price. But if you have a quality company that you've invested in, that you're writing contracts against, then the likelihood of you losing money decreases. So the quality of the company does matter. I do recommend that you sell covered calls and you buy companies that you don't mind owning for a while that are going to do well, so that if you reach your price, you can sell those shares at a profit and you can actually get income on them, and the stock price is expected to go up over time, and you're writing contracts on covered calls on stocks that will go up in value. So that's the premise of selling a covered call. Let me know if you've got any questions in the chat so far on selling covered calls. So I'll pause just for a minute to let you ask any questions that you've got, or if you want to come off of mute. Okay, no questions yet. That is okay. So I want to share with us a live example of selling a covered call. And I know the stock market right now isn't open, so we're not going to get like the latest prices, but we're going to see the last prices of what some of these contracts are going for. And we can use Macy's as our example and take a look at one contract for Macy's expiring March 17th at $25. So we'll use this example. So I'm going to already have bought these shares. So this is the trading ticket for me to buy my shares. And let's say I'm going to buy Macy's. And remember, we need to buy 100 shares of Macy's. And we can see here on the pop-up, the last price of Macy's was $22.66. It was down 4 cents for the day as of Friday. And that was the last price. But if the market was open, we'll see this price fluctuate. And let's say we bought these shares at the market price in this account, and we took ownership of these shares. I'm just going to pretend that we did. Now that we own these shares, 100 of them at $22.66, that was our required capital. So I'm just going to pull up the calculator. So 2266 times 100. Of course, we want to include any commissions. Hopefully you have free trades and you're not getting charged commissions from your broker. And it required capital of $2,266. So that's what it required for us to own these shares and buy 100 shares of Macy's at the last price of $22.66. Now that we own these shares, we can go and write a contract, one contract, on these 100 shares that we just bought at $2,266. So I'm going to go back in my account, and trade options. All right, I'm going to set up my order ticket. And on the Merrill Edge platform, you'll notice here, it's kind of easy, very intuitive to set up the ticket, the trading ticket. If you're on, Robinhood, Fidelity, very similar procedure. So no matter the platform you're on, it'll be a similar way in how you'll trade or set up your trading ticket. So our underlining symbol is Macy's. The ticker symbol is M. So we're going to select Macy's. We see the last price, $22.66. The action here, remember the option structure requires us to define an action. We are going to be selling to open. This is an opening transaction. We're selling a contract. We're going to sell one contract. It will expire on March 17th. And our strike price is $25. I'm not the one who made up these strike prices. This is the options exchange that determines what the strike prices are. So here is a strike price of $25. We'll select that. And this is going to be a call option. So once I have this part of the ticket set up, I can see right away what the last price was that the contract traded for, the $25 strike price expiring March 17th. And as a seller of a contract, we're going to be looking at the bid price, this area here of the ticket that says bid. And the bid was 7 cents. Remember that one contract represents 100 shares. So you're going to multiply that 7 cents by 100. That means for each contract that you're writing, you're earning $7 per contract. That's the premium, what you're going to earn. So you can set up your ticket for the market or the limit. That's the detail. So your contract can be written for or exchanged at the market price of 7 cents, or you can set an actual limit price. Sometimes you have a fluctuating market, a moving market, and maybe the contracts are going to be trading a little bit below or above 7 cents per contract. If you want to guarantee the premium that you're going to be earning, you want to sell at a limit order and actually enter your limit price. That could be 7 cents in this case, or if you predict the price of this stock to continue going up throughout the day or throughout the week, the month, you can actually look for a higher premium. Maybe you want to earn $10 per contract. So that's 10 cents here will mark up on the ticket, and you can capitalize on the value of the stock going up, because let's say tomorrow, or rather on Monday, because today is Saturday, on Monday, this stock price goes up to $23. You're going to see the bid price go up. So you want to set a higher limit of, let's say, 10 cents, or receive $10 per contract. So that might be more realistic. So as the stock price goes up, let's say to $23, $24, your higher limit price will be reached. You'll earn more premium, more than $7. You can earn $10 per each contract that you do right. So the beauty of, as you see, writing contracts is also capitalizing on the money you have sitting around. Maybe you have $10,000 sitting in your savings account. You can put that $10,000 to work and earn. Remember, we're in March, so this is expiring March 17th. In 1 month, you can earn, let's say, $200 or $100 just for holding a contract of these shares. And you'd have to, of course, buy more contracts. So one contract will give you, right now, the current bid price was $7. So we'll go with that right now. Let's say we want to earn $200 or somewhere in that range. So let's see how many contracts we would need to get there. So just doing 200 divided by our $7. We'd need about 29 contracts. So we're going to round up 29 contracts to earn $200 by March 17th. That's a lot of money. That's a lot of money. That's a lot of capital. 29 contracts on Macy's. So we would have had to purchase, and my math might be off, 29 times 100, 2,900 shares. So we need to buy 2,900 shares. That's a lot of shares to write 29 contracts. But if you've got the money, you can make this happen and get about $200 or so by March 17th. So 2,900 shares. So we would need to spend, and that was 22.66, the share price. We would need $65,000 to earn about $200 by March 17th. So if you're a high roller, you've got a lot of money to work with, you can capitalize on that money just sitting in your account and earn $200 by March 17th. And if we look at, if you're a smaller investor, that's not too bad. Let's say, your capital requirement, let's say we only bought 100 shares. So we needed $2,266. And oops, let me put that back again on the screen, times 100. And let's say we earned $7 of $2,266. So 7 divided by 2,200 and 2,266. That is just about look at that over 12 months, not too bad, but you can earn more. So other stocks besides Macy's might give you a higher rate of return. This is just an example of Macy's and what we're going to get from Macy's. Other stocks, maybe Ford, might give us a higher rate of return. Depending on what the premium are, the ratio, what the premium is that we would get for having 100 shares of Macy's, of Ford. So we can take a look at that example. So I'll pull up Ford. Let's say we bought shares of Ford instead, like at $12. It was like at $12 a few weeks ago. And I'm going to set up my ticket, sell to open, one contract of Ford expiring March 17th. Let's say our strike price will be $14.35. This is a call contract. Okay, all right, so they're going for $4, possibly more. The last price was $5 per share, per contract. So that's not too bad. Let me just plug this in. All right, I had to plug in my charger so that the computer won't die. So here, let's say we bought 100 shares of Ford, and I'll put my calculator again so we can see what that looks like. 100 shares at $12. Our requirement, we spent $1,200 to buy these shares of Ford at $12 per share. We've got 100 of them. And our strike price for this contract is $14.35. So we would earn money if it gets executed on March 17th. If we reach expiration and on March 17th, those 100 shares of Ford are now trading at $14.35, we would earn the profit and we would get to keep the premium of the $4 for this contract. So let's see what that ratio looks like for Ford. So $4 divided by our 1,200. But you can still earn a little bit, but that might be higher. What you're earning in the account that month might be higher than the interest you're getting in a savings account. So it's nice to have a little bit more realized or annualized rate of return on the investment that you have. So not too bad at all. Definitely check my numbers, folks. Make sure my calculations are right. But you'll see that annualized rate of return increase as you continue to earn more money. Maybe the bid price, the premium that you're earning goes up tremendously. Then you can earn more money on your investment of the shares that you purchased that are just sitting in the account. Looks like we've got a question here. Someone asked, can we do Lucid? Yeah, let's take a look at Lucid. So let's say we bought some Lucid shares and we own 100 shares of Lucid in our account right now. So because we own those 100 shares, we're going to write a covered call on Lucid. So I'm going to go set up my ticket, selling to open, one contract of Lucid. Let's say it expires March 17th. My strike price, let's say we bought them at $8.94. We bought them on Friday, just yesterday. And I want my strike price to be $9.50. And this is a call contract. Oh, holy moly, folks. I would earn $30 per contract on Lucid. So, holy smokes. So I would earn $30 per contract. Not too bad at all, Mr. Smith. So here, let's say, and I'm going to do the math. Pull up the calculator. And let me put it front and center so we can see. So we bought at $8.94 and we bought 100 of them. So our capital requirement required us to spend $894. That's what we gave up to own these shares of Lucid. We have optimistic values. We have optimistic vision on Lucid. We see Lucid going places, and the price of Lucid will go up in the future. So we are comfortable with buying 100 shares of Lucid. I spent $894. Now that I own these shares, 100 of them, on the expiration on March 17th, if Lucid hits $9.50, I will earn the difference, the profit from between $8.94 and $9.50. Let's see what that profit looks like. So let's say that was $9.50. So $950 minus $8.94. We would earn $56 in profit just for doing the transaction. And and having it expire. Remember, this is if it expires at $9.50. We would earn $56. And we're also going to keep the $30 for even writing this contract. So this is pretty good. So I am going to add that $30. That's $86 that we would receive on March 17th. I'd earn $86 that I didn't have before in my account and earn that money. And let me just take a look at what that return looks like. So I'm just going to do the $30 divided by the $8.94. So that's also about 3%. Actually, no, not 3%. That is 3%. Oh my gosh, my math. Yes. Move that decimal point over. So about a 3% rate of return, not too bad as well. But it's really nice when you annualize that over time. It gets higher and higher as you write more contracts. So not too bad earning $30 on $894 that you spent to buy the Lucid shares. So that's a great example. Okay, so Mr. Smith asks, what if it goes to $17 before March 17th? So let's say your contract was for $9.50. If Lucid goes all the way up to $17, your contract will be fulfilled at $9.50. So you do lose out on earning what you could have earned on just selling the shares at $17. So you lose the ability to earn that extra profit because you're going to sell your shares at $9.50. That was the agreement on the contract. So you don't get to sell them at $17 if it's trading at $17 in the future. You're only going to earn the difference. You're going to earn $9.50 per contract if it's trading at $17 in the future. You can also have your contract get assigned or your shares sold out of the account early. That is called early assignment. Let's say it's March 10th and Lucid jumped up to $17. You can see the shares get assigned a lot earlier. They might not wait. The options exchange might not wait until March 17th to fulfill your contract. They'll fulfill your contract sooner than that because it's trading at $17 per share, way above $9.50. So you lose out on selling them at a higher price and you lose that potential profit you could have earned at $17. So that's also the risk that you take. But if you wanted to sell them anyway, then you don't really lose. You get to sell your shares at a price that you're comfortable for. So it's a really good idea to set your strike price at a price that you're comfortable selling. And let's take a look. If we were to set the strike price at $17 for March 17th, because we think it's going to jump up, possibility. Right now, those contracts are going for $2. So 2 cents or $2 per contract. So you wouldn't earn a whole lot on profit, but if it did jump up to $17, at least you'd earn a higher amount on the spread on the profit. All right, so it looks like we've got a question. So someone asks, is it advisable to always set a strike price higher? Yes, it is. The goal in 90% of the situations, it depends on what you desire, but most people want to buy low and sell high. So it is advisable to set a strike price higher than what you bought the shares for, so you can earn a profit and sell the shares at a higher price, set a higher strike price. So that is something you want to do. I know you might be in a situation where you just want to get rid of the shares, but you want to write a covered call. You might set the price lower just to get rid of the shares and earn a little bit of premium. So that's a whole completely different situation. but the whole idea is to earn a profit. So hopefully you bought the shares low enough so you're setting a strike price that's high enough and you can earn a premium while you're waiting to get to that price. And as each week goes by or each month goes by, you can set that price, that strike price, higher and higher over time. Yeah, that was a great question. Right, let me know if you've got any other questions. I'll pause just for a sec to see if you've got any questions before we take a look at puts. All right, no questions so far. All right, that is okay. So I'm gonna pause back in our example. So here, let me pull up the slide. Our next strategy. So we're gonna talk about selling put options. So we saw what it was like to sell a call option, but to sell a put option, it's entirely different, but you get to earn money while you're selling a put option. And if you're not comfortable with owning stock, this is actually a better strategy for you. And it lets you participate in the stock market without actually not having to own any shares at all. But it does require you to have capital or the money that would be required to buy the shares if the contract was to be fulfilled, was to execute. You will see the income that you receive increase, the potential income increase when the stock price goes down. So for selling puts, as the stock price goes down, the premiums go up on these contracts. That's how you capitalize on earning money on selling puts. So let's take a look at some examples on selling put options. So here we are going to sell a put on Chico's, on CHS, that's the ticker symbol. And our strike price is $5 for this put. Oh, I should have the word put over here, not call. Let me just change that real quick on the slide. Oops. Okay, there we go. Oh, it took us all the way here. Let me fast forward to the slide on that. Here we go. Sorry about that. So we're selling a put option. So CHS, Chico's is the company. Chico's FAS, retail company, retail stores around the US. And our strike price is $5 for this one contract. And our put contract is expiring on May 19th, a few months from now, of 2019. So if we reach $5, that's our strike price, our contract will be fulfilled. But the way a put works is betting on the stock price going down. Or staying up, hopefully, so you get to keep your premiums. So let's say in the future on May 19th, if the price of Chico's goes below $5 or is at $5, so we're at $5 or below, then our contract would be fulfilled. That means when we have an assignment or a fulfillment, we are on the hook and we are responsible for buying 100 shares of Chico's at $5 per share. That's what we're on the hook for. When you're setting up your trading ticket or setting up your purchases and you're selling your puts, you want to be comfortable with the strike price. In this case, it's $5 that you're going to be setting up. And if you're comfortable with $5, that probably means that the average price of Chico's has probably been trading at $5 or somewhere around that, and you're comfortable with buying these shares at $5 per share if the contract was to get fulfilled. You have to be comfortable with the strike price that you set up for puts. So since we're going to be comfortable with buying 100 shares of Chico's at $5, that could happen in the future. We have to have that level of comfort and we have to be ready. That means we also need to have the cash in the account. So your broker will require you to have $500, because remember, one contract represents 100 shares. So if we pull our calculator up, 100 times 5 is 500. So we need at least $500. That is our capital requirement to do this. You need $500 in cash. And we're going to sell this contract and earn a premium. We're going to earn money for the possibility or the likelihood of this contract reaching $5 on May 19th. So I want to share some examples and mock up a trade ticket so we can see what that looks like. So I'm going to go back in my account and I'm going to see what the premium is that we're going to earn. So I'm just going to clear this. On the trade ticket, I'm going to put in Chico's, CHS. So I don't need to own the shares. I can go right ahead and set up the contract, but I do need to have the money, the $500 as a balance in my account. My broker will see my balance and let me do this contract. So I have CHS as the symbol. So the action here will also be sell to open. That is the action. I am going to write one contract expiring May 19th. May 19th is our expiration date. And the strike price is at $5. And this is going to be a put. So we're saying on May 19th, Chico's will hopefully not be trading at $5. It'll be trading somewhere above $5. We want to earn money on this contract, and we don't want to be on the hook for buying these shares on May 19th because we expect Chico's to be trading at somewhere above $5 on May 19th on expiration. I don't have to do anything until May 19th comes. But if Chico's is trading at $5 on May 19th, my broker will go out there and use the $500 that is set aside in my account and will fulfill the contract. So I will have bought those 500 shares, those 100 shares at $5 per share. So I'm going to set up my trading ticket. So you can also set up a market order or a limit order. So I like to use limit orders so I can guarantee what premium I'm going to earn. And right now, one contract for Chico's is going for $10. You'll earn a premium of $10 for one contract. So that's what I will earn. I'll put this here, 10 cents, which represents $10. So I will earn $10. That is my gain, my maximum gain on this contract. If for some reason this contract gets fulfilled, my maximum loss, because I've earned money, just the difference between $500 and $10 is $490. That's as much as I can lose. If the stock was to go all the way down to zero, I lose up to $490. But the likelihood of that happening hopefully is unlikely because we're writing contracts on quality companies. Hopefully you're writing contracts on quality companies and you're not likely to lose your money. But it does show you here in the ticket the maximum loss if everything was to go down. So let's say everything was okay. May 19th came around a few months later, and Chico's was trading at $6. It was right now, it's at 6.34, and it stayed up there. It's still at $6. Maybe it came down a little to 5.99. As long as it's above $5, you're going to keep your $10 premium and you're going to earn that $10 once once it reaches May 19th. So let me know if you've got a question about that in the chat. I'm just going to pull up my calculator just so we can see what that ratio looks like. If I was to earn $10 on $500, so I earned a $10 premium and I had to put up $500 in cash and leave 500 in my account for this contract. That is move the decimal point over, 20% rate of return. So I will be earning 20% on my money. That's really great. Not bad at all. Is that right? I mean, 2%. Oh my gosh, I can't do math. So, folks, okay, keep me honest. But that's not totally horrific. So if you have less capital to put up, selling puts is also a great way. This stock only required you to have $500. So you must have the $500 in the account that you would need to fulfill this contract if it was to get fulfilled on May 19th. I only needed $500 to do this, and I earned $10 by May 19th. Not too bad at all. Keep in mind that if the price, let's say the price of Chico's was actually at somewhere in the $5 range, like $5.10, $5.15, 20, 30, $15, excuse me, $5.40. If it was trading somewhere in the $5 range, the premium would be way higher, much higher, to actually fulfill the contract. So you would earn more money if the current price of the stock was closer to the strike price. So you do earn more money if the spread is tight and the price is trading at a price that's close to the strike price. I'll just pull up a contract here for $6. Okay, so we don't have any bids right now. There are no prices on the $6 strike price expiring May 19th. Let me just do March to see if we have a price here. Okay, so for March, not bad. The bids are at $10 or 10 cents, $10 per contract. But of course, the last price is much higher than the bid because it just went up to $6 like 2 days ago. This increase just happened. So you're actually earning, if you were to set up a limit order or sell it at the market, you could potentially earn $19. That was the last price. So you might get somewhere around $19 for one contract. So that's a little bit more than a 2% return. So you'd earn $19 on $500 that you're putting up as capital to do this. And it looks like we've got a question in the chat. Can you cancel an already written contract? Yes, you can. So with any contract, whether you're selling a covered call or selling a cash secured put, you're selling a put, you can close your transaction. So here on the trading ticket, so right now this is not held in my account. Let me do one that is. I think I've got one here. Oh, so I don't know what's in my account right now. But I could have sworn I had one. Yes, I do. All right. here we go. This is a good example. So I own, and the trading ticket knows if you have the contract in your account. At least this broker does it that way. Other brokers should do it the same way too. So the ticket recognized that I didn't hold that contract. So it was looking for something to close. So here, my action will be buy to close. So before, if we go back to this slide, you were earning a premium you were earning money. If you're going to close these contracts that you are earning money on, it requires you to buy instead of sell. So the terminology will be different. You'll be buying to close the contract out. So that requires you to spend the money you would have earned or you did earn on the contract. You're going to lose some of the premium or more. It could cost you more to close the contract out than the premium you actually earned if you want to close that contract. And to see what the premium price is on your trading ticket, you're going to be looking at the asking price. So this is what the offer is. So it would, for this contract I have in my account right now, it expires May 19th. The strike price was $5 and I want to close it out. So I would be looking at spending $15 per contract to close this contract out. Hopefully, when I initially sold the contract, I earned a lot more than $15 because it's going to cost me $15 per contract to close this out. Let's say I earned $50, which I did on these ones. I earned $50 per contract. So I would earn the spread between that. Let's say, what is that? $35. Let me just pull up my calculator. So 50 minus 15. Yes, $35. I would earn I get to keep the $35 spread. So when I wrote the contracts, I got $50 per contract, but I closed it out before expiration. It would cost me $15. I would only earn $35 for each contract. So hopefully you're in a position like that where you actually earned more money. You earned a lot more money on the contract when you wrote it versus what it is costing you to close that contract out. So you want to sell high and buy low. You can buy out the contract at a lower price than what it cost you to write the contract. I sold the contracts at $50, but I'm going to close them out at $15. I only earned $35. So I hope that answered your question. Let me know if it did. Feel free to come off mute if you've got any questions so far. So that was our example. Right? I'm going to buy to close, and I'm buying to close because I sold to open. I'm now buying to close. So I just want to share an example here of a put contract that I wrote in the account. So I was selling puts. I was selling puts on this company called Asana. ASAN is the ticker symbol. I think I did this around December when we were in a bear market. You know, the market was down, all the stocks were down, things were not looking optimistic. The Fed was pushing out all this news and all this mumbo jumbo, as we're still continuing to hear about interest rates increasing. So don't forget, when interest rates go up, stock prices go down. So as interest rates were expected to go up, stock prices were going down because of that and in anticipation of interest rates going up. So stock prices were down. So in December, I wrote a contract to sell 10 puts of Asana. I wanted them to expire on January 27th. So this was in December. They're going to expire January 27th. So, folks, question, what did I need in order to sell these puts? If you can remember what we needed to do this, feel free to write it in the chat or come off of mute. Yes, that's right. So Tasha just said I needed money or capital to sell puts. So since I was selling 10 puts of this company called Asana, I was agreeing to put up capital to have money in my account that would support the purchase of 10 contracts if these contracts were to be fulfilled on January 27th. My strike price was $13. So I was saying that I would agree on January 27th, I would agree to buy, I was at 1,000 shares, 10 times 100. So each contract is 100 shares. So that's 1,000 shares. I was agreeing to buy 1,000 shares of Asana at $13 per share. So I needed around $13,000. So I put up $13,000 in my account to agree to buy 1,000 shares of Asana on January 27th. I did this in December when the stock was around $12, and I'm comfortable with buying 1,000 shares of Asana at $13. To me, I see Asana going places. It's a startup, making moves, still working on becoming profitable. Buying 1,000 shares at $13 would still be a profitable move for me. So I was okay. I was very comfortable. If this contract executed, I would be okay with spending $13,000 to buy 1,000 shares at $13 per share. You can write contracts for less. Remember, you could buy one contract. You don't have to buy 10 contracts. But in this case, I wanted to buy as much as I could and set it up at $13. So I went ahead and earned $309 in that 1 month. I earned $309. I did this in December. The contract expired January 27th. I earned $300 later, 30 days later, because Asana was trading, going to show you here the chart, on January 27th at $15.54. So it was trading at above $13. My agreement was to buy these shares if it was trading at $13 or less. If the stock was at $13, I would buy the shares at $13. If it's trading somewhere below $13, I would buy these shares. I would be on the hook. But the total opposite happened. The stocks went back up. It climbed back up. You can see here where it dips and it climbed back up. And on January 27th, it was trading at $15. So it was above $13. So I was no longer on the hook on January 27th on expiration. I was no longer on the hook for buying these shares. I got to keep my premium. I kept the $309 and I was not on the hook for buying these shares at all. So I earned that money and I didn't have to buy those shares at $13 per share. If it was at $13 per share, as you see here on the chart, if it was on January 27th, $13, I would buy those shares and own those shares. And I'd have to wait for those shares to go up, to sell the shares so I can earn a profit, or I could even change my strategy. So even though I started with selling a put, maybe it got assigned, it got executed, I fulfilled my contract, I can now roll that over and turn that into a covered call and start writing covered calls on the shares that I now own in the account because I had to buy them at $13. But so that's a continuation of what I could have done. But in this case, I didn't have to do that because it was above $13. So I don't have to spend the money to actually buy those shares. I get to keep my premium. I keep $300 because the stock is above $13. Let me know if you've got a question. I see folks coming off of mute. Let me know if you've got a question in the chat. And as you're thinking of any questions, also keep in mind that it might look like small money. Maybe your premium is $10, $20. You're not buying like 10 contracts. You can start out with writing one contract. That money adds up. That's 10 more dollars that you have in your account that you didn't have before. But if you have the capital to write 10, 20 contracts, you want to maximize your ability to earn as much as you can. So you can actually write, 10 contracts and earn like $200-$300 in 1 month and use that money that's just sitting there to earn as much as you can just on writing contracts. So I don't see any questions so far come up in the chat. Somebody just asked, what are some other stocks that you can write contracts on? Pretty much any stock that the options exchange makes available. So not all stocks have option chains or option contracts. If I pull up my account really quickly, as you're searching for different stocks to write contracts on, you will notice this one isn't working. I don't know, it's not coming up. But I was hoping to just show you a few more examples. Oh, it's not reacting. So I'm trying to pull up JetBlue. I can't remember the symbol. But basically, any stock that's trading on the stock exchange, if it is eligible for option writing or option contracts, buying or selling, you will be able to look it up and see what the option chains are that are available for you to write contracts against or buy contracts against. So it depends on the underlying stock. Not all stocks have options that you can write against, but most of them do, which is a really great feature of the stock market. That was a great question. And I just want to open it up. If you have any other questions in the chat, feel free to drop those over. I'm going to drop my YouTube channel here so that you guys can get a chance to rewatch this in the future. And I think I've typed it out right. That's my tag there. So I hope that this was informative and useful information for you to start earning money so that you can earn premiums on money that you have sitting around, or even change up your strategy. Maybe you've been trying to buy and sell stocks. Maybe you should switch it up and write contracts. You're comfortable with buying shares and you want to earn money on those shares that you've bought, or you are comfortable with earning money on the money that's just sitting there and selling puts. You can earn money on selling puts and earn those premiums on money that's just sitting around. Instead of trading stocks, buying and selling, you can actually hold on to contracts. So it's a great opportunity to get involved. It's semi-passive, and I hope that this was helpful for you to take you to that next level so that you can start out writing contracts, selling covered calls, or selling cash secured puts. Feel free to send me any questions that you have. I can drop my email or my contact information below in case you need to reach out if you don't have that already. And feel free to write a comment on this channel in case you do. And I know this is really the start for some of us. Don't be afraid of doing any of the things that I showed you how to do today. Experience or the money will come when you actually start doing this. And I'll be happy to jump on a call with you to walk you through your first trade so you can get started with doing any of this. And someone just asked, can you start writing contracts on stocks that you already own? Yes, you can start writing covered calls on stocks that you already own. Keep in mind that for covered calls, you need to have at least 100 shares. So you need to own 100 shares already of that stock. That was a great question. So if you own 100 shares and they're just sitting around, you can write covered calls to earn you some extra income. All right. Well, thanks everybody for all the questions and for tuning into this live. I know this was fun. I love talking about the stock market, making money. And my goal this year is to earn at least $10,000. That might be a far-fetched goal, but I have a little bit of cash I'm working with in my play accounts. So hopefully I reach that goal. I'll post an update towards, well, beginning of next year so we can see how far I actually got with the money that's sitting in the account. And I hope this was helpful. Thanks everybody for tuning in again. Don't forget to subscribe to my YouTube channel if you haven't done so already for more content. Have a great day, everybody.